In this full video course, you will learn everything you need to know about order flow for trading stocks, crypto, forex, or any other financial market. By the end of this course, you will not only be able to trade order flow like a pro, but you will also learn multiple order flow trading techniques that most traders don't know about. Alright, so hello everyone and welcome to this ultimate course on order flow trading. Some real quick things before we start here. First of all, this will be a pretty long video, so make sure to get ready. Perhaps bring out a notebook, maybe even a coffee, because we will dive deep today. But if you want to take trading seriously and start making money with order flow, you really need to dive deep. This is not something you can do in 5 minutes. You need to at least be able to spend 1 hour where you sit down and learn everything you need to know. And that is what we're gonna do in this video. I can also just mention that I have built this video in a step-by-step manner. So I highly recommend that you watch all of the chapters in order. So you start from the beginning and you go to the end. But if you want to jump around in the video, don't worry. I will make sure to have YouTube timestamps slash YouTube chapters, so you can, jump through and, perhaps replay a chapter. Or if you want to jump over a chapter, you can do that as well. But as I said, I highly recommend to watch the chapters in order. Last but definitely not least, I also want to mention that, in order for the knowledge in this course to really stick, I also highly recommend that you practice what you learn here. Don't just acquire the knowledge. If you want the knowledge to really stick, it is important to train the concepts you learn in this video. But okay, so before we can start making money with order flow, we of course first need to know what is order flow trading in the first place. And in very simple terms, order flow show you how candlesticks are actually formed. So you can basically look inside a candlestick and take a look at, it's like a more detailed view of a candle. So you can see here, it reveals what happens inside each candles. It reveals the battle between buyers and sellers. Traditional charts only show the results. So if you have a normal candle, you only show, the price result of that candle. But with order flow, we can dive even deeper and show the cause. Why did the candle form? And if we can understand why the candle formed, we can, as a result, make better trading decisions and, hopefully, as a result of that, make more money. So here, by studying order flow, we can see who controls the market and understand why price moves. It's super important if you want to improve as a trader to understand the reason behind price movements. So one analogy is like it's like giving our chart an X-ray and show the real activity behind each bar. And now let's super quickly jump into TradingView here. I just want to give a little sneak peek on, how the chart will look like after this course. And you might look at this chart and think that this sounds super complicated, but I promise you, if you watch this full course, you will understand exactly what's going on this chart right now. You will be able to read it. But to do that, you really need to pay attention to this course. I can also just mention right away that the charting platform I use for all my technical analysis and the charting platform I will be using in this course is TradingView. And if you want to follow along and use all of the tools I use in this video, I think you might need TradingView Premium. But don't worry, because I do have a special link that you can use to try out TradingView Premium for free for 30 days. And if you, after the trial period, decide that you want to continue using it, you will get a $15 bonus. So I recommend to use that link if you want to follow along with exactly everything I do. But if not, don't worry, you can use the free version of TradingView as well and follow along with most things. But right, so now let's switch attention to take a look at something super important, and that is how buyers and sellers set the price. Or in other words, how are the buyers and sellers creating the candlesticks you see on the chart? Well, you can think about all markets, whether it's crypto, stocks, or Forex, like auctions, where buyers and sellers are constantly negotiating for prices. In simple terms, buyers always want to buy as cheap as possible, and sellers want to sell as high as possible. This is very logical. If you want to buy something, whether it's, crypto or maybe it's, food, you always prefer to buy lower. And if you sell something, you always prefer to sell higher. And the price here, where both sides meet, the buyers and sellers meet, are known as fair value. And fair value is something you can write down in your notebook. This is something that will come up again and again during this course. It is a very important concept. And here, when both sides agree for a while, so when they agree during a long period, the price tends to move sideways and you will see volume build up. This is what is called a balanced market. And when we for some reason have one side becoming stronger, this is what is known as an imbalanced market. So here you can see a simple example of a balanced market and an imbalanced market. Remember, a balanced market is a period of time when prices are roughly the same. So for example, if you look at this period right here, this right here is a balanced market. And in balanced market, you will often find trading ranges or consolidations. This is basically all kinds of movements when we have the price going roughly sideways. But then we also have periods like right here. This right here is an imbalanced market. This can be, sharp moves or trends to the upside or sharp moves or trends to the downside. And these markets are very important to be able to spot as traders, because in these markets, we can make lots of money. These are usually the kind of move we are trying to catch, because trading within balanced markets like right here is often, much harder than, trading and riding the waves of imbalanced markets. And one more thing that can be a little bit hard to understand in the beginning is that, you might wonder, okay, so what is the fair value? Well, the fair value of this market is all of the prices. So when we are right here, this right here is the fair value, because this right here was the moment where buyers and sellers agree and a transaction took place. So it doesn't matter where we are in the market, if we are in a balanced or imbalanced markets, all of these red dots here are fair value, are the fair value. But as I said, don't worry if this sounds complicated right now. It will get more and more clear throughout the course. The rest of the course, these two ideas are, first of all, something known as the value area. This right here is the range where about 70% of the trading took place. And this 70% basically comes from, in simple terms, it comes from one standard deviation in statistics. You don't really have to worry about where this comes from, but this is a very common percentage that traders use, and you will learn all about it. The next important concept we need to learn about is something known as POC, or for short, or for long, I mean point of control. The point of control is the exact price level where the most volume got traded. So it's showing the market's we can call it fair price. It's not really the same as fair value as we talked about earlier, but point of control is the level where most volume took place. Okay, so to understand value area and point of control, I want you to look at this image right here. You can see the black line right here. Imagine that the black line is a price movement, and here the value area, remember the value area is where 70% of the trading took place. So in this case, the value area is this yellow area right here. We can call this area the VA. And you can see that this tool we have right here is something known as the volume profile, and you will learn about it later on in this course. But you can see that the taller the bar are, the more volume got traded. So for example, right here, very little volume got traded, while for example, right here, tons and tons of volume got traded. And the value area, so the area between, this point right here and this point right here, you can hopefully see that on this chart, this was the area where indeed pretty much all price movement happened. You can see only very little price movement happened outside of this area, and this is why this is known as the value area. But then we also have the point of control. And remember, the point of control is the exact level with the most volume traded. And in this case, we can see that the most volume traded was this bar right here. The tallest bar is the most volume traded. And so this right here is our point of control. And you can hopefully see on this chart that it does make sense that this was the point of control, because this one touched the price touched right here, right here, right here. You can see lots of trading has been taking place on this price level. And the concept of value area and volume, the value area and point of control can not only be applied to the volume profile, which we're talking about here. You can actually use these concepts when you look inside candles as well. And that is one big reason why I wanted to talk about the value area and point of control already this early in the course. But alright, so now it's finally time to start diving deeper and take a look at how trading works behind the scenes. So now we will start learning about how the candles are formed. And first of all, what we really need to learn about is the different order types in the market, because every candle you see on the chart is created by orders being filled and matched. So all of the candles are created by either, players jumping into the market and buying or selling, or they can also be created by, for example, stop loss orders where, sellers, like for example, you and me, place an order that, if the price goes down to a certain price, we will automatically sell, or if the price goes up to a certain price, we will automatically buy. These kind of orders also are very important. So now let's take a quick moment and learn about all orders. And don't worry, I will show you guys a visual explanation of this very soon. But first of all, we need to know what the different orders are called. The first order is the most simple one. This one is known as the market order, and this one gets filled immediately at the current price. So if you, for example, place a buy market order, that means that I want to buy, let's say, Bitcoin. If you place a market order on Bitcoin, it means I want to buy Bitcoin right now for the current price. Or if you place a sell market order, it means I want to sell Bitcoin right now for the current price. Then we also have a limit order, and a limit order is filled at a better price. And remember, as buyers, we want to always prefer to buy at cheaper prices. So buy limit orders are placed below the price, sell limit orders are placed above the price. The stop order is the opposite. This one is filled at a worse price after it gets triggered. So for example, stop sell order is triggered below the price, and this is worse because you always want to sell high. But as I said, this is a bit hard to understand if you don't have a visual, so I will show a visual very, very soon. So, but two important things you need to know about market orders and limit orders is that market orders moves the price. The market orders moves the price because they take liquidity that is in the book. Limit orders, on the other hand, add liquidity because they are placed in the market and they will wait there until the price moves there. So for example, if Bitcoin is right now trading at, let's say that Bitcoin is trading at 100,000 and you place a limit order at 90,000, this one will not affect the market right now until the price actually goes down to 90,000. And here, a very important principle. Every trade happens because one trader buys and one trader sells. This is very important to have in mind, but it's still very different if you are, buying because of a limit order or a market order. All right, so now let's take a look at the different trading order types. And this right here is super important for the rest of the course. So make sure to really pay attention. And I hope this visual will really help. And let's begin here by taking a look at the long position. By the way, if you don't know, long here means when you long something, it means that you bet that the market will go up. So you want the market to go up. And if you short something, this is the opposite. This is when you want the market to go down. You make money when the market goes down. By the way, if you want to learn how shorting works, I do have a video about that. I will make sure to link the video in the video card so you can watch it after this course. But for now, when it comes to going long, remember here that the limit order is always at a better price. So your sell limit, because you always want to sell for as much as possible, you can see that the sell limit is above the price where you go long. So this is the case where you go long at market, you place a market order. Let's say that you place a market order and buy Bitcoin right now at 100,000. The sell limit is always at a better price. So maybe you set the sell limit at 110,000. And also remember that the sell stop, the stop order is always at a worse price. So maybe you set your stop loss here at 95,000. So always have this in mind. The limit is better, the stop is worse. The limit is better, the stop is worse. But how does it work when you go short? Well, let's say that you go short here at Bitcoin at, let's say this is 110,000. Remember here that the stop loss is always at a worse price. And when you go short, the price is worse when it's higher. Because remember, when you go short, you want the price to go down. So let's say that you go short at 110,000, then your stop might be at 115,000. And your buy limit might be at around 90,000, because remember the limit order is always at a better price, and when you short you want the price to go lower. So in other words, in both of these cases you can think about the limit order as a target, right? Because if you buy at 100,000 you can have a target at 110,000. And in the short example you can also think this as the target, because you want the price to go down, and if it goes down, you make money. And also in both of these cases, you can think about the the stop order as the stop loss. In the case of a long position, your stop loss will be when the price goes down, but in the case of a short position, your stop loss will be if the price goes up. I really hope this visual and explanation helped you guys understand the different order types. But alright, so now it's finally time to take a look at the order book and the market depth. And as you hear in the name of this course, it's called order flow trading. You already hear on the name that the order book is very important, and you're not wrong, the order book is super important here. So let's lock in and pay attention. But to begin here, what is the order book? Well, the order book is basically a list of all pending limit orders waiting to be filled. And remember here, limit orders are orders we place in the market. They don't get executed right away. They will sit there and wait. And that is why they get placed in this book. And the left side of the order book shows buy limits. So this is, buy limit orders. And the right side show sell limits. The buy orders tend to be green. The sell orders tend to be red. And don't worry, I will show you guys a visual very soon. But here, and this is important, the order book can actually be pretty hard to read, but there is something called depth of market, or for short DOM, which is a more simple version of the order book. The depth of market uses, clear colored bars to show how many orders that exist at each price. So the more orders we have, the longer the bar will be, and it's very, as I said, visually appealing and easy to learn. And I will show you this very soon. And here we have two important concepts. First of all, we have something known as a deep market. A deep market is, in simple terms, when we have lots of orders in the order book, and this can make the market more stable, because in order to move the price, we need to eat all of the limit orders. And the opposite of a deep market is a shallow market. This is when we have fewer orders, and because we have fewer orders, a large player can move the market very easily. So this means larger and quicker moves. And here, and this is very key, the price rises when aggressive buyers clear the sell orders, because this is the only way for the price to move. Or the opposite can of course also be true. If aggressive sellers clears the buy limit orders, the market also moves. But now let's jump in and take a look at order book and depth of market. But right, so now let's take a look at the depth of market, or for short DOM. And you can actually think about the depth of market as the same thing as an order book. The only difference here is that the depth of market is easier to read, because in the depth of market, or DOM, the length of the bars, so for example, if you take a look at the sell side, the length of the bar will correspond to how many sell limit orders that are in the market. So let's go over this in a step-by-step manner. So first of all, we have two sides. The green side here is known as the bid side, and this is where the buy limit orders are placed. So you can think about bid as buy limit orders, and the ask side is the sell limit orders. And what you also can see here is that you have the price here in the middle. So let's say that this is a stock. It right now trades at around 100, and you can see here at the price of 105, we have 85 sell limit orders. So 85 orders are waiting at that price level, and here at 104, we have 72 orders waiting, 103, 68, and so on and so on. And the same thing, but the opposite is true on the green side, the buy limit side. So for example, if we take a look at the price of 99, we have 24 orders waiting. At the price of 96, we have an order to buy 92 waiting. And let me actually be more specific. The numbers here are not how many orders or how many people that want to buy. The numbers are how many stocks or how large the total orders are. So this is, you add up all the orders. So for example, this 92 side might be, 3 orders in total. One that wants to buy 90, plus one that just want to buy 1, and another one that wants to buy 1. So it can be just 3 orders, but the orders should add up to 90. I hope I'm clear here. But now, the next very important concept I want to talk about is the concept we talked about with deep and shallow markets. So remember here, a deep market is a market where we have lots of orders. So for example, if we take a look at this part right here, we can see that this part is much deeper, right? So this part is pretty deep compared to, for example, this part right here, which is much more shallow. And remember, we call it deep and shallow because if someone wants to move this price and push the price up to, for example, 103, it's pretty easy to do that, because in order to push it up to 103, you only need to eat up, all of these orders. It's not a lot of orders. It's like 90 or something. But if you want to move the market when it's deeper, like for example up here, you can see it's much harder. You need more money in order to move the market. And once again, the same thing is true, but the opposite on the buy side. So for example, this right here is a shallow market, while this part all the way down here, I hope you can see, is much deeper. And yeah, guys, this is all you need to know, at least for now, about order books and depth of markets. Let's continue the course. But right, so now we need to switch the attention here and take a look at a pretty big problem with real-time order flow. And that is that we are seeing tons of manipulation in the market. So the order book looks pretty clear, but one thing that you really need to learn is that not all orders are real or honest. And there are many different types of orders and different types of manipulation tricks that you really need to learn about. So make sure to pay attention now. Let's begin here by taking a look at some common manipulation tricks. And the first trick you need to know about is something called spoofing. This is actually a pretty simple trick. And this is where traders place large fake orders to trick others, and then they cancel the orders before they get filled. So I want you to have the order book you learned about earlier in the course in mind. What traders can do is that they can place massive amounts of limit orders in the book to maybe give a sense that, this is actually a deep market. Or they can even give a sense that, there are so many sellers right here. There are so large, let's say that they place very large sell limit orders. This can actually scare away, for example, small traders like me and you, because we think the market is, it's so deep on the sell side, which can make us sell. That is just an example, but spoofing is a real thing. You place fake buy and sell limit orders in order to affect the price. Another, order type you really need to know about is something called iceberg orders. And what is this? Well, an iceberg order is a big hidden orders that only show a small part. And this is something that many trader platforms actually have built in. And this is, you can place an order in the order book. So let's say that you want to buy a total of 100. But instead of placing the 100 in the order book, you can create an order that plays 10 at a time. So you place 10. When the 10 gets eaten up, you will immediately place 10 more. And when this 10 gets eaten up, you will immediately place 10 more. And when this gets eaten up, immediately 10 more, and so on and so on. This is how iceberg orders work. When that part gets filled, a new part appears, and this is basically hiding the true size of the order. So this is also a way of sort of manipulating the market. The last thing I want to talk about right now is something called layering. And layering is placing fake orders at several levels to create the illusion of demand and supply. So layering is basically, it can be either spoofing, or it can even be things like, combining spoofing and iceberg orders. There are many different ways to manipulate the order book, and this is a big problem for traders like me and you. But don't worry, I will have the solution very soon later on in this course. Yet another problem with the order book and live order book trading is that not every trade has a directional goal. Different traders have different motivations and goals. And what do I mean by this? Well, first of all, speculators and basically, this is basically normal traders like me and you, we of course care about the trading direction. When we buy, we really want the price to go up, because if it goes up, we make that's how we make our money. Or if we short, we really want the price to go down, because that is how we make our money. But there are some trader types that don't care, if the price goes up and down. There's one trading type called arbitrage trading, and this is basically, in very simple terms, when you buy one market and sell another, and they don't really care about the direction. This is a simplification, but don't worry, if you want to learn more about arbitrage trading. I do have a video about that. I will make sure to link it in the video card as well as the description below, so you can check that video out after this course if you want to. Another type that don't really care about how the market moves is something called hedgers, and they basically use a market, one market, to protect another market, and by doing that they don't really use it to predict the price, so they also don't really care about the direction. So we as traders have to be careful. It's very easy to look at an order book and think that every single order in this order book have a motivation. Every single order is trying to move the price, and this is not true, because there are some traders like arbitrage traders, like hedgers, that actually don't care about the price movement. This is very important to have in mind. Another thing that we need to consider is that not all volume is visible. This is once again almost like manipulation, or it's like a way to not affect the market. We have something called OTC, over-the-counter trades, that basically happens in private. So these kind of trades never show, traces in live order books or even in the market. They often get reported afterwards, but in live order books, they don't even show up. Another similar thing is something called dark pools. And this is when, large investors, smart money, institutions, not small retail traders like me and you, this is where they trade in secret until they reach a good deal. And this is also, at least, in the live market, this is also often completely outside the information of us retail traders. But overall, what you need to learn from all of this is that real-time order books can often give a misleading picture. But now the question, of course, becomes, if this can be misleading, what can we as traders do to get a more accurate picture of the order flow? All right, so now it's finally time to take a look at our first order flow trading tool. And the first tool we're going to talk about is called footprint charts, or in other words, volume footprint. And this right here is a super useful tool. You can use it to, first of all, you can use it to find out what actually happened inside a candlestick, and as a result take better trading decisions. But you can also use the volume footprint to find market structure, like for example support and resistance levels. But here, footprint chart is basically a chart that shows how much buying and selling that happened inside each candle. And don't worry, I will very soon show you this visually, and that usually makes it much more easy to learn. But in simple terms, each price level has two numbers. So each price level inside the candle has two numbers. We have a left side, which is red, which shows the sell volume. And it's very important to notice that this sell volume is market orders. They are orders that are taking liquidity from the book, while the right side is the green side, that is buy volume, or in other words, it's market orders. So we on the green side, we are taking we're taking from the sell limit side. If this sounds complicated, don't worry, it will be super clear soon. And here are some of the most important terms and features you need to know about when it comes to the volume footprint. The first concept you need to know about is something called delta. And delta is, in very simple terms, the difference between the buy and sell volume. So if we have a positive delta, we have more buy volume than sell volume, which means that buyers are in control. And if the delta is negative, it basically means that the sellers are in control. The next concept here is the point of control, and you already know about this concept if you didn't skip over any part of the course. The point of control is simply the price inside the candle where the most trades happen. And this is very important to learn about, because we can actually use the point of control to find, for example, support and resistance levels. I will show you how to do that step by step. But here, we also have the value area. And this one you also know about. This is the area, but in this case inside the candle, where about 70% of the candle's total volume got traded. But here we're starting to get into some more new concept. The first concept you need to know about is something called imbalances. And an imbalance when it comes to volume footprint is when one side trades 3 times or more than the other side. So for example, if the buying side buys 3 times or more, for 3 times or more volume compared to the selling side, then we have a buy imbalance. And the opposite is true. If we have 3 times or more sellers, then we have a sell imbalance. This sounds complicated now, but once again it will get cleared. And here, stacked imbalances is basically when we have multiple imbalances on top of each other. But now let's take a look at how a volume footprint candle actually look like. Alright guys, so now it's finally time to take a look at the volume footprint. And this right here is one of the most important tools we will cover in this course, so make sure to really pay attention now. The volume footprint is basically like having an X-ray on the candlesticks. Before watching this course, you might have only been trading, looking at candlesticks, but what the volume footprint allows us is to see what actually goes on inside the candlesticks themselves. And this might look, super complicated in the beginning, but I will try to break this down in super simple terms, step by step. So first of all, the first thing we need to learn is that we have a buy side, which is the green side, and we have a sell side, which is the red side. And what these sides basically tell us is how much buying volume on the green side and how much selling volume on the red side happened at all of these specific points inside the candle. So all of these specific price points inside the candle. So if we just look at a random price level, let's for example take a look at the one at the top. You can see that it says 0 on the buy side. I hope you can see it says 0 right here, but on the sell side it says 32. That means that we saw 32 of sell volume up here on the candle, while we saw 0 buy volume. And now you might think, you might be confused and think that, for every time someone sells, someone has to buy, right? And yes, you are completely true. But what this volume, what the numbers here tell us is not the sort of total volume. What this tells us is the market orders. Because remember, market orders is when you take liquidity from the book. So in this particular case, we saw sellers, taking liquidity from the buy side. This is what pushes the price down, while we saw no buyers taking liquidity from the sell side. It's very important that you notice that the buy volume is buy market orders and the sell volume is sell market orders. The volume footprint tells us all about who is controlling the price, who is pushing the price up or down. And you do that with market orders, not limit orders. Remember, limit orders are placed in the book. But now, when you know this, you now know that volume footprint is all about who is pushing the price up or down. Is it buyers or sellers? And now, there are a few important concepts you need to learn. The first one is called delta. And we already talked about delta. That is basically the difference between the buy side and sell side. So for example, if we take a look at the delta here at the lowest part, you see right here, we have 14 on the sell side and we have 8 on the buy side. So this right here is actually a -6 in delta. Or in other words, we have 6 sell volume in delta. But what you can see down here, you can see that we actually have a total delta. And that is if we add up the deltas of all of these blocks, we get the total amount of delta during the whole candle. And in this case, you can see that we had 1.4 thousand bullish delta, which means that the buyers were actually in control over this candle. The next concept you need to learn about is the point of control, or POC. And remember, this was the level where the most volume got traded. And in TradingView, you can see super clearly where the point of control is, because the point of control will be marked with this black bar right here. So in this case, the point of control was right here. And the point of control is very important because we can use it, for example, for support and resistance levels, and it can give many other hints as well. Now, the next concept we need to learn about is the value area. And remember here, the value area is where around 70% of the volume got traded. And when you look at volume footprints, you will see two markers. You can see it says value area high right here, or for short VAH, and it says value area low here, or for short VAL, and it is between these two lines, so this area right here, which is the value area, or for short VA. As once again I can repeat it, that this was the area where around 70% of volume got traded, and it's very common that the value area is often, relatively small compared to the candle. You can see, for example, in this case, 70% of all volume within this candle actually got traded on the upper side, and that can give a signal that this candle is maybe more bullish than if 70% got traded down here. Okay, so now it's time to take a look at imbalances. This right here is very important, and this is when one side, so either the buying side or the selling side, traded at least 3 times as much as the other side. So for example, the imbalances you can see by this little dot you have right there. You can see you have a little dot right there, you have a little dot right there, you have a little dot on all of these 3 right here as well. But one thing you can notice is that if you compare, you see it says 304 here, and here it says 118. And you might think, 118 times 3 is actually more than 304. So how is this an imbalance? Well, the trick here is that you actually need to compare it diagonally. So you need to compare it like this. You can see 304 is more than 3 times as large as 87, and that is because the buy side will always be one step above the sell side. This is a bit hard to understand, but you will start to see a pattern. You can see here we have an imbalance because 141 is more than 3 times larger than 21. Once again, here we have another imbalance because 45 is of course more than 3 times as large as 0. Once again, here we have a diagonal imbalance because 45 is more than 3 times as large as 14, and the reason we don't have an imbalance in the next one we don't have an imbalance because 104 is even larger than 88. You always need to compare the imbalances diagonally upwards when you do it from the buy imbalances, but the sell imbalances is the opposite. And here you can notice the same with the sell imbalances. Right here we have a sell imbalance, and right here we have a sell imbalance. Why? Because 87 is more than 3 times as large as 0, and 543 is more than 3 times as large compared to 157. So I hope this makes sense. And you might wonder, how can we use this buy and sell imbalances? Well, I will very soon show you a concept that is known as absorption and initiation. A little bit hard for me to pronounce, but these concepts can be super helpful in understanding the strength of each candle separately. But before that, I want to take a look at how we can use volume footprint as support and resistance and in our trading strategy. Alright, so now let's jump back into TradingView right here. I am currently looking at the daily time frame of Bitcoin, but you can use volume footprint charts in crypto. You can also use it for stocks. You can also use it for Forex, but it's a little bit, the data in Forex is a little bit more unclear, so volume footprint might work a little bit better in stocks and crypto, but it does work in Forex as well. And here, as you can see, I'm looking on Bitcoin right now, and just like as a side note, we saw a big sell-off in crypto yesterday. But one very, cool thing you will notice is that Bitcoin actually bounced where we saw something significant happening on the volume footprint. And I will show you guys that very soon. But first, let's of course take a look at how do we open up the volume footprint in TradingView. Well, to do this, you want to go up here to where it says candles, and then you want to go down right here to where it says volume footprint. And right now, I'm not 100% sure if volume footprint is available for free in TradingView. If you have a free account, please check and let me know down in the comments. But if it's not available, don't worry, because I do have a special link to TradingView. You can use that link to try out TradingView Premium completely for free for 30 days. And if you want to, if you like it enough, I'm pretty sure you will, or at least I do. But then you will get a $15 bonus if you want to continue on your trading plan. But to open the volume footprint, you simply click right here. And just like that, the candlesticks are transformed into a volume footprint. And now you already know how to read these footprints, or here, your footprints might actually look a little bit different to mine, and that is because I do have another setting right now. So what you want to do if your candlesticks looks like this is that you go to the settings tab, and right now you can see that I have type delta. I think the standard type is to show both the buy and sell side. So let's choose buy and sell right there, and then press OK. So your chart should look like this. You should see, both the buy side and the sell side, just as I showed you recently. And when you zoom in here, you can clearly see, how aggressive was the sellers, how aggressive was the buyers. You also have the delta explained right there. So was the sellers in control during the candle, or for example, like right here, was the buyers in control? But now for this trading strategy, I want to show you one way you can use volume footprint to find support and resistance. And this is a very simple trading strategy, super easy. And what you want to look out for here is that you want to look out for clusters of point of control. This is super easy to spot. For example, right here on the chart, you can see that we have multiple black bars happening at the same time. And remember that the black bars are the levels within the candles where the most volume got traded. And these levels where we have lots and lots of volume traded can often act as magnets in the future. So what we can actually do here is that we can draw a support area. What I usually like to use is go to geometric shapes and use my rectangle. And then you can see we can draw this support area out right here. And you can see, if we drag the support area out, you can actually see that this was exactly where Bitcoin bounced before we saw this beautiful move to the upside. And if we even look at the candle that happened just yesterday, you can see that we did see a beautiful bounce at this area. After you have done your analysis on the volume footprint, it can often be helpful to go back to the candlestick charts and see how the price reacts. And you can see that in this case, the price beautifully bounced right here. We saw a massive move towards the upside, and the price also bounced at this key support just yesterday. And if you're looking for a super simple trading strategy from this support level, it could have looked something like this. You use your long position, so you're looking to make money from the price going up, and then you see the price coming down to the support, and you might enter at the first strong reaction from the support level, setting your stop loss just below the low right here, and with a risk to reward ratio, your trade would have looked something like this, and you would have locked in some very nice profit. But now you might ask yourself, is this, analysis, it seems super easy. Is it enough to only have sort of one bullish sign, which in this case is support, and then take your trade? Well, not really, because in order to make the trades more likely to succeed, we preferably want to combine it with other technical signals as well. And this leads us to the next thing we're going to talk about in this video, which is absorption and initiation. Alright, so now let's switch attention and take a look at two super powerful concepts when it comes to order flow trading. And this right here is absorption and initiation. These concepts can seem a little bit complicated when you first hear about them, but I will try to break them down and simplify them as much as possible. And in very simple terms, absorption and initiation are simply concepts that help you see who is winning the battle between buyers and sellers within a certain candle. And here, first of all, we have absorption. And this is when the price moves in opposite direction of the imbalance. And this right here is a sign of a potential reversal. So I want you to you can write this down in your notebook, that absorption means reversal or weakness. Then we have initiation. This is when the price moves in the same direction or with the imbalance. And this right here is a sign of continuation and strength. So absorption, weakness, initiation, strength. Make sure to write this down. And from this, we can actually have 4 total scenarios. First of all, we have bullish absorption. And this is where we see selling imbalance up here. So we see selling here. But then the price goes up and closes higher. And this means that the buyers absorb the selling, and this is a sort of bullish reversal. Then we also have bullish initiation. This is when buying imbalances appear and the price pushes in the same direction, which means that buyers are attacking. So this is strength or continuation. And then we have the opposite. We have bearish absorption, and don't worry, I know this probably sounds like super complicated right now, but I will soon show you a visual and it will be so much more clear. But bearish absorption is the opposite. We're seeing buying imbalances up here, but prices close lower. This means that sellers absorb the buying. And last but not least, we have bearish initiation. This is when selling imbalances and the price go in the same direction, which means that the sellers are attacking. Alright, so let's begin here by taking a look at the absorption. And remember here, when we talk about absorption, we are talking about weakness. And one thing that might sound a little bit counterintuitive here is that the red one is actually the bullish absorption and the green one is the bearish absorption. And I'm sorry if the drawing here is a little bit ugly, but what I'm trying to show here is that the green dots right here and right here and right here are basically buying imbalances, while the green dots, for example, right here and right here are selling imbalances. And let's start here by looking at the red candle. The reason this one is bullish, absorption, is because even though we saw selling imbalances right here, so we saw lots of selling coming in right here, we also saw lots of selling coming in down there, even though we saw selling, the buyers managed to push the price up, and we actually, the bears lost control, and the bulls managed to close the price above above and despite all of this selling pressure. So as you can see, this candle looks a little bit, if you have been studying candlestick patterns, it looks a little bit like a hammer candlestick. And what you will notice if you study hammer candles is that many times they will have this bullish absorption happening. So this is basically that sellers try to push the price down, but they fail. The selling pressure gets absorbed and pushed up. That is why this is a bullish sign. But now if we take a look at the bearish one, which is often a green candle, this is the opposite. You can see in this case, the seller, was super aggressive. They pushed the price higher. They took a lot of liquidity from the order book. But even though they took a lot of liquidity, the bears before the candle closed managed to push the price down, and we actually closed all the way down here. So I hope you're understanding why why the red candle in this case is bullish and the green candle in this case is bearish. It will be important to have in mind throughout the rest of the course. Okay, so the next concept we're going to talk about is the initiation. And in my opinion, this one is often easier to understand, because in this case, the bullish initiation is the green candle. Bullish tend to be, green, and the bearish is a red candle. And this is very similar to the absorption we recently talked about. But in this case, you can see that the imbalances and the direction goes in the same way. So for example, if we in this case start with the bullish initiation, so the bullish initiation, you can see that we have buying imbalance right here, we have buying imbalance right here, we have buying imbalance right here. But what you also can see is that the price goes in the same direction as the imbalances. What is very important to notice here is that when it comes to bullish initiation, we want the candle to close here. You see the candle closes right there. We want it to close above the imbalances. Because what story does this tell us about the price? Well, it tells us that the imbalances tells us that, lots of aggressive buyers took liquidity from the book and tried to push the price higher. And what the candle close tells us is that the aggressive buyer succeeded with doing this. So the aggressive buyer succeeded, which is a very bullish sign. The opposite is true for the bearish initiation. So here we have selling imbalance right here. We have a selling imbalance right here. The aggressive sellers tried to push the price down by taking liquidity from the book. And by looking at the candle close, we can notice that the aggressive sellers indeed succeeded with pushing the price down. And now it starts to get super interesting, because we can use initiation and absorption together with, for example, let's say that we have a support area or maybe even a demand area right here. We might see, let's say we have a trend that comes down like this, and then we might see some bullish, let's say we see some bullish absorption coming in right here. So we have on the sell side, we had some selling imbalances, but the buyers managed to push the price up. And then after this absorption, we might see some initiation, right? We might see a bullish green candle that looks something like this, that managed to see buying imbalances and close the price higher. When we're using initiation and absorption together with, for example, support and resistance, the trade gets stronger and more likely to succeed. And as a result, we are more likely to make money. So if we now jump back into TradingView, we can try to analyze the trade we looked at earlier a little bit more in depth. So once again, we want to open up the volume footprint chart. I can once again remind you about my link in the description and the pinned comment that you can use if you have no access to the volume footprint. But we open up the volume footprint here, and let's see if we can find any sort of absorption or initiation. Well, if we look at, first of all, you remember the support area comes from all of these point of control, so it's good to have that in mind. But what you can notice is that we didn't really see any absorption right here. But what you can see is that on this green candle right here, what did we have? Well, we had a buying imbalance right here, which means that we saw, aggressive buyers trying to push the price up. And we can also see that the price indeed closed above the imbalance. So this right here is initiation. That is a bullish signal. You can also see from the next green candle right here that we saw, I hope you can see, it's a bit hard to see, but we had one imbalance right here and two imbalances in a row. And once again, the candle closed above. So we had yet another initiation candle. So here we can once again, to make the chart a little bit more clearer, we can go back here to the candles, and because we had initiation on this green candle, right, it makes our, that is yet another bullish variable, and that is an argument for taking this trade. But now you might of course wonder, is volume, you might already think, volume footprint seems like an amazing tool, but you might think, is this the only tool we can use, or can we use even more tool to become even better at order flow trading? And the answer is yes. So let me show you guys the next tool. Alright, so now it's time to take a look at our next tool. This right here is a super powerful tool, but it can be a little bit hard to use, and it can also be hard to actually find the right tool in TradingView and to set it up. But don't worry, I will go over everything in a step-by-step manner. But first of all, this tool right here is called the Cumulative Volume Delta, or for short, CVD. And by this point, you already know what volume delta is. You know, it's the difference between the buying volume and selling volume. But here on the name, you can hear cumulative. That is basically that we add up the volume delta or the volume difference over time. So you can pretty much hear on the name that the CVD measures the total net buying or selling over time. So it basically adds up the volume delta of every candle to show if, you know, aggressive buyers or aggressive sellers are in control of the market. And here the interesting signals start to come when we compare the cumulative volume delta to the price. So because when we do that, we can start to see, you know, who is actually in control of the market. So for example, if the price goes up and we're also seeing you know, the cumulative volume delta go up, we're seeing that the aggressive buyers are succeeding in pushing the price higher, right? So we often have a strong, healthy move. And here, what you can specifically look out for is divergences between the CVD and the price. So two of the most common divergences, don't worry, I will show you every divergence you can look out for, very simple terms, but you can look out for buying exhaustion, and that is when the price prints higher highs and the CVD prints lower highs. You can also think about this as, you know, bearish divergence that you, for example, see in momentum indicators like the MACD. And by the way, I do have a full, like, 1 hour long course on the MACD if you want to dive deeper, you know, into you know, indicators that are based on the price action later on. I will make sure to link that video in the video card and description. But we also have selling exhaustion. This is basically the bullish divergence when we see the price printing lower lows while the CVD making higher lows. And both of these divergence types is great for spotting potential reversals or even some hidden absorption. Alright, so here I basically have made a cheat sheet of all the different CVD divergences you can find, and don't worry, I will go over all of these step by step, but if you want to get access to this image and all of the images from this today's presentation, I actually release all the presentations to our YouTube community, our YouTube channel members right here on YouTube. If you want to become a channel member, you can do that by clicking join down below. And as I said, all gold and diamond members get access to presentations like this one, but also more things like, you know, exclusive videos, priority replies, you get some emojis, some badges, and at the same time you support the channel. So if you like this kind of content and want to support the channel, consider becoming a channel member by clicking join down below. But now let's go over the divergences. So first of all, you have the orange side right here, that is the price, and you have the blue side, which is the CVD indicator. And when the price prints higher highs, like we're seeing right here, you can see one high and higher high. Let me actually change the color here so you can see clearly. And when the CVD at the same time prints lower highs, then we have a bearish divergence, and that is a signal indicating a potential reversal to the downside. But also we have something called hidden divergence. This is harder to spot and a little bit harder to understand, but that is when we already have a downtrend. So we already have lower highs on the price, but the CVD prints higher highs. This is actually a bearish signal, but it's a bearish continuation signal. So it's a little bit different. But in this video, we're all going to focus on the normal bearish divergence and bullish divergence, but I just want to include the hidden divergences as well, because you can definitely use them and they can be super valuable. But now the normal bullish divergence is when the price prints lower highs, so you can see lower lows, one low and then a lower low, while the indicator prints higher lows, one low and then a higher low. So lower lows on the price, higher lows on the CVD. That is a bullish divergence indicating a reversal to the upside. Last but definitely not least, we have the hidden bullish divergence. This is a continuation signal because the price is already printing higher lows, but then we see the CVD printing lower lows, and this indicates a continuation to the upside. But now I want to take a look at how we can use the CVD, and more importantly, how to find, the best CVD in TradingView. All right, so now let's once again jump into TradingView, and let's continue using the Bitcoin chart, because in some other courses, you guys, always wonder, how can we really apply this to all markets and so on and so on. So to keep it consistent, I will try to use the same chart here and just use Bitcoin. But now, how do we open up the CVD indicator? Well, to do that, we want to go to the Indicators tab in TradingView. So you press right here, and you want to search for CVD. And then you can see here, first of all, you can see that we have a built-in indicator that is called Cumulative Volume Delta. Some traders use that one, but that is not really the favorite indicator for me. What I like is one called Cumulative, I think it's called Cumulative Delta Volume, like this. And it's this one right here, created by Lonesome the Wolf, I think is called. You can see it should say around 8.8 thousand as I'm recording this video. So you press this one right here. And just like that, the indicator should appear here at the bottom of the screen. But now, in order to make this indicator better, at least in my opinion, and easier to read, I want to change a few settings. So what we do is that we go down here to where it says Settings, and then I actually want to change the inputs here, and instead of using candles, I prefer to use a line. So I will change this one to a line right here, and then so you guys can see it more clearly, I'm gonna make it a bit more thicker like that. And for now, I think we're ready to go down here and press OK. But now remember what we're looking out for. We're looking out for when the price prints, when the price and CVD goes in the opposite direction. So for example, if we look at this low and this low, you can see that the price clearly prints lower lows. But in this case, the CVD goes in the same direction. So here we actually had no divergence. So that is, one sign that wasn't bullish about that particular low. But we still, this was where we created the support, and this was where we saw the next bounce. But here, if we look a bit earlier, you can actually see a super clear divergence. You can see right here, we had, one high right here, and then we printed a higher high. So the price prints higher highs. But if you look down to the CVD, you can see that the CVD creates a super clear lower high. And remember, when we have higher highs on the price, lower highs on the indicators, this right here is a bearish divergence indicating a reversal to the downside. And after this divergence up here, we indeed saw a reversal. Let's actually scroll back even more, see if we can find any other kind of divergences. Let's zoom in a bit on the CVD. Well, right here, you can see an example of the opposite. We have one low, then a lower low on the price prints lower lows. But if you look closely at the CVD, you can see that the CVD prints one low and then a higher low. This right here is a bullish divergence indicating a reversal to the upside. And after this divergence, we saw a beautiful move up. All right, so the next order flow trading tool you need to know about is the volume profile. And the volume profile is actually pretty similar to the volume footprint, but you actually have a little bit more flexibility when it comes to the volume profiles. And you will understand why very soon. But first of all, what is the volume profile? Well, the volume profile shows you how much volume that got traded at each price across a range of candles. So instead of just zooming in with an X-ray on one candle, the volume profile can make you look at multiple candles at the same time and assess the volume at each price level. So it's basically like turning your chart sideways to see where the most trading occur. And what you will realize here is that many of the key concepts for the volume profile are the same as the concepts for the volume footprint. So for example, when it comes to the volume profile, we also have the POC, which is the point of control. And you already know that this is the price level where, you know, the highest volume got traded, or in other words, the market's fair value. Then we have the value area. This is the area where about 70% of the total volume got traded. But here are two new terms. We have something called a high volume node and a low volume node. And these terms are very simple. High volume nodes are tall bars. And I will show you this exactly when we take a look at the visual, but they are basically tall bars on the profile, which represents lots of volume traded, and low volume nodes are short bars on the profile, which are levels with very little volume. And two key things to have in mind is that the high volume nodes are known as areas of acceptance, and they can actually often act as magnets because, you know, a lot of volume have been traded there in the past. It's likely that many market participants will accept these levels and trade them in the future. So many times they can act as magnets and kind of become support and resistance levels. They are not strict support and resistance. It is important that you should not look at high volume nodes as, you know, clear support and resistance levels, but they can definitely be useful, and I will talk about that later. But the opposite is true here for low volume nodes. Low volume nodes is known as areas of rejection, and this is, you know, the price tends to move through these low volume nodes very quickly. So you can use this, for example, to improve your breakout trades, or just to find areas on the chart where the price is more likely to move in a quick and low liquidity manner. All right, so right here you can see an example of a volume profile indicator. And as you can see, compared to the normal volume, where the volume bars are down here, the volume profile is actually right here on the side. And the first thing you need to know about the volume profile is that the height of the bars represents the amount of volume. So when we have short bars like right here, and right here, that means that little trading volume and little trading activity appeared at that level. While when we have, you know, tall bars, like for example, right here, and right here, and right here, it means that lots of trading occurred at that level. And if you look at the black price line, you can see that I have tried to show that in this area, you can indeed see that the price spent a lot of time within this area. So the price had, you know, more opportunity to get volume traded in this area. But what you also have to notice is that it's not only how long that the price spends within this area that matters. What actually matters is how much volume got traded inside the candles of this area. So you could, for example, imagine, you know, an area where the price goes up quickly, but tons and tons of volume got traded. But now let's take a look at the key terms you need to know about. And the first term is the point of control. And the point of control, as you probably know by now, is actually this bar right here. So this is the POC, which stands for point of control, and that is simply the tallest bar. It is the area where the most volume got traded, and this is an area where, you know, it's likely to often act as a magnet. So have that in mind. The next concept you need to know about is the value area, and the value area is this yellow area right here, and this is the area where 70% of the volume got traded. So these yellow bars represent 70% of the volume. So this area is like a broader and a little bit less significant point of control, but the same principle applies. The price tend to move more slowly through this area compared to how fast the price tend to move during the areas with less volume. Two more concepts you need to know about is the high volume node and the low volume node. And this right here is an example of a high volume node, or for short HVN, and this simply means a tall bar, a bar with lots of volume, while for example this bar right here is a low volume node, or for short LVN, and this is a bar with little volume. And as I have mentioned multiple times, the high volume nodes, the price tend to move more slowly, and the low volume through the low volume nodes, the price tend to move more quickly. But right, so now let's jump back here into TradingView. We are still looking here at Bitcoin, and we're currently looking at a volume footprint chart. But to make the chart a little bit more clear for now, I'm just going to switch to normal candles for a while. And now we're ready to open up our volume profile indicator. And to do this, you want to once again go up here to the indicators tab in TradingView, and you want to simply search for volume profile. And here, as you can see, we as usual, we have many built-in volume profile indicators. The difference between these indicators is mostly, where on the chart should we put our volume profile. You also have multiple built-in indicators, and I do think these pre-built indicators, I do think they are available on the free plan, or maybe you need an essential plan. But if you need a paid plan, as you probably know, if you have been watching this full course, I do have a special link. It will be both in the pinned comment and the top of the description. And you can use that link to get try out TradingView Premium or any other TradingView version for free for 30 days. So if you can't open up this indicator, make sure to use the link. But here, you have, for example, the visible range volume profile. This one will give you a volume profile for the chart you're currently looking at. So when you zoom in and zoom out, the volume profile will change. But if you want more control, you can use this fixed range volume profile. And when you click on this one, you will notice that nothing will happen. And that's because you need to decide the range of the indicator. Let me see here. So you click on fixed range volume profile, and then you need to press on one point on the chart like I did right here. Then you will see two dots will appear on the chart. And this is where you can choose, from what time period do you want to display the volume profile. So here, what I want to do here is that I want to analyze how the volume looked like during this impulsive move to the upside for Bitcoin, because this was a significant move. So I want to know, where did the volume got traded during this period? Because if we know the volume during this move, you can actually think about it as, having looking at this part of the chart like almost like a volume footprint, right? You get, instead of looking at one candle, you get a volume for the whole period. And one interesting thing we can notice, right away, remember what the volume profile tell us. When we have areas, for example, right here, you can see that we had no volume. And in these kind of areas, remember what I said, the price tend to move quickly. And what actually happened when the price came to this area, you can see right here, the price indeed sharply moved, through this area. But once the price already moved through, the next time it didn't, move through as fast. So that was one interesting thing we could see about this volume profile. Another super interesting thing is, if you look here at the point of control, which in this indicator is this red line right here. Remember, the POC is simply the tallest bar, and you can see the tallest bar is right here. But you can see that this point of control, if we draw a support line right here, you can actually see that this was where we found support earlier in the course, right? This was the level where, the price bounced the first time. And remember, this was the level where we found support from our volume footprint. So that is super interesting that we have the point of control at the same level. And yet another thing, we can see that Bitcoin, as I talked about earlier, we recently saw a massive crash in Bitcoin. And what you can notice here is that the price actually bounced at this level. So I think this demonstrates very clearly how the volume profile can give you both hints about when the price is about to move fast, and we can also get hints about, you know, where is the price likely to, you know, act as a magnet. And in this case, it worked out beautifully. We saw 3 bounces right here on the volume profile. But alright guys, so now you know about the volume profile, you know about the volume footprint, you know about the cumulative volume delta. I would say that you now know more than 99% of traders when it comes to order flow trading. So congratulations if you made it this far in the course. If you have liked the course so far, make sure to drop a like. You can also drop a comment. It really helps out with the YouTube algorithm and all that. But last but not least, before we wrap up here, I just want to give a quick summary of how to use the tools together. So remember here, the volume profile shows we are on the chart, we are on the price levels, the battle between the bulls and bears appeared. We can see on this level, there were, you know, lots and long battles on the chart. And in this level, you know, pretty much nothing happened, which means that the price can move quickly through that level. The footprint chart is when we give an X-ray to the candles. We can see how the battle played out inside the candles. The footprint is super important. If you still find the footprint hard, I highly recommend to go through that part once again, because the volume footprint will build upon all of the previous in order to understand the next chapters, like the cumulative volume delta, you need to have a basic understanding of the footprint. So don't be, you know, shy to maybe rewatch the whole course to really lock everything in. But the CVD shows who was who was winning the battle over time. Remember, the CVD, we're adding up the deltas over time. And you can combine these tools in multiple different ways to improve your trading and as a result make more money. So you can, for example, use profiles to find, you know, what zones that are worth watching. You can use footprints to both look for absorption and initiation, and you can also use it to find better support and resistance levels. And you can use the CVD to find divergences and to sort of see the overall bigger picture, who is winning the long-term battle. And as a general rule of thumb, when price and delta agree, the move is stronger. When they diverge, it's weaker. And here, and this is super key, you know, you now, as I said, you know more about order flow than pretty much everyone. But in my personal opinion, you really want to combine order flow with market structure and price action. And luckily, I do have a full video course on market structures. I will make sure to link that one up in the corner in the eye. And I also have a full course on price action. I highly recommend that when you have the time, you definitely don't do it right away. You deserve a break after watching this course. But make sure, you know, promise to go through both of these courses later on. Both will be in the video card. And last but definitely not least, I do have some extra material, some extra tools, some extra indicators, but this course is getting long, so I will save these tools and the rest of this presentation for our YouTube channel members. If you didn't know, we have an amazing community right here on YouTube where I share full presentations like this one right here. I will make sure to share the images from this course so you can, you know, have it to help you study order flow. And I also post, you know, exclusive videos. You will get priority replies and much more. So if you want to join the community and get access to more content, make sure to become a channel member by clicking join down below. And now guys, as I mentioned earlier, in order to use order flow effectively, it's so important to learn about market structure. So when you have the time, I highly recommend to watch